on a day like today, when there is a bit of a risk-off feel, and you actually have something of a dip, albeit a pretty minor one at this point, are you in there trying to find those airline, those hotel stocks, or rather bonds, to get in and try to add to risk?
Hi, Lisa. Good morning. Well, we are constructive, particularly over the medium to longer term. There's no question that near term, the virus is spiking and we are getting a little bit of a risk-off tone. But yes, we want to be selectively adding risk on these sell-offs because if you look at the next 6 to 12 months, we actually see a lot of stimulus in the system, both from monetary and fiscal policy globally. And we also see an economy picking up steam in 2021. So we expect double-digit corporate profit growth. And there's many areas of the market that have significantly underperformed in 2020 that we think actually will catch up next year. And so we are selectively adding risk into sell-offs.
Mark, is this just a bet that the Fed has the credit markets back no matter what?
Well, Lisa, if you look at global central banks throughout 2020, global central banks will have bought $8 trillion of assets. So this is really unprecedented, and that's not even counting the $3 trillion of government stimulus just in the U.S. with what is likely going to pass today. So the markets are being flooded with liquidity. Money market funds are sitting on $4.5 trillion, which in my estimate is at least $1 trillion too high. And then in addition, you've got significant money on the sidelines with private equity and corporate profits set to go up double digits. So the bottom line here is that central banks have markets back right now simply because there's no inflation. And so without inflation, you can expect the Fed and other central banks around the world to continue to support markets. And this only changes once you get inflation above 2%. And in the United States, that could take 2 years.
All right, Mark, but then there's a question of what happens when companies are zombie companies and perhaps aren't making enough money to cover even their interest payments, and yet the Fed's policies allow them just to keep borrowing more and more money. When does the time run out for them?
So, Lisa, what we've seen in 2020 is really something unprecedented. And really, the Fed and the government's policies disproportionately helped large cap companies. So there was significant differentiation. The large cap companies that were able to get money through the markets actually were able to term out their debt and raise significant liquidity. So some of these large cap companies, believe it or not, are sitting on 18 to 44 months of liquidity. There's no question that some of the smaller firms, the small cap companies, did not get that assistance and frankly will face a rising bankruptcy threat. So 2020 really will go down in history as how COVID created significant winners and losers. What we've been focused on is the large cap companies, the companies that actually have built up a war chest of liquidity, and those companies that also see significant upside over the next 1 to 2 years if we ultimately get this vaccine to roll out and we get the global economy to recover.
There's a question, though, how much more returns are there? I mean, it's one thing to say that they're going to outperform, but I'm looking at CCC rated bonds. They've returned 11% since the end of October. That is less than 2 months performance. We are talking about corporate bonds, not stocks. How much more upside is there?
So we would really be more cautious on the CCCs. We're not really diving into the riskiest credits right now. The value we see is in some of these triple Bs and the double Bs, which actually have, again, 18 to 44 months of liquidity, so that as you get this rebound in travel, which realistically could take 6, 12 months, even 18 months, but as it occurs, these companies have significant operating leverage. So the bottom line, Lisa, is we want to stay higher quality. Those companies that have built up that war chest of liquidity, so own less CCCs, but own those double Bs and those triple Bs, which actually have significant liquidity cushions right now.
So that means that you say to people, you need to lower your returns expectations, right?
Absolutely. I think if you look at 2021, we are going to be looking at much more modest returns. At the same time, I do think you want to own more equity beta in portfolios because you've got 3 things happening. You've got global economic growth picking up in 2021. Number 2, you've got central banks around the world supporting markets. And number 3, you've got the lag effect of fiscal stimulus. So these 3 factors, I think, are going to result in double-digit corporate profit growth next year. In fact, in some of these industries that Pimco likes, like the travel and tourism industry, you're talking about a significant pickup in profit growth over the next 1 to 2 years. So the markets will still be supported, and so selectively, you do want to take more equity beta risk next year.